between a rock and a hard place. Kevin Warsh, Inflation Expectations and the Yield Curve Trap. Flint West Reporting. Section 1. Every hero walks onto the battlefield carrying a weapon. For a Federal Reserve chair, there are only two. The first is the interest rate lever. Pull it up and borrowing becomes more expensive. Push it down and liquidity begins flowing through the economy once again. The second is the balance sheet button. Expand it and the Federal Reserve injects liquidity into the financial system. Shrink it and liquidity is withdrawn as financial conditions tighten. That's it. Two tools, two levers, and one mission. Section 2. On the 22nd of May, 2026, Kevin Warsh took the oath as the 17th chair of the Federal Reserve. His objective was deceptively simple: guide a $28 trillion economy safely back to the Federal Reserve's canonical 2.0% inflation target without breaking the real economy along the way. Simple on paper, brutal in practice, because Warsh didn't inherit an open playing field. He inherited a gauntlet, 5 structural obstacles, each one capable of stopping monetary policy dead in its tracks before it ever reached the end zone. Section 3. The first obstacle: fiscal dominance. The Federal Reserve wants to cool the economy. The United States Treasury is doing the opposite. Washington continues running massive, multi-trillion-dollar annual deficits. Month after month, new Treasury securities pour into the primary dealer network to finance government spending. While the Federal Reserve attempts to restrain financial conditions, fiscal policy continues injecting fresh borrowing requirements into the marketplace. More Treasury supply requires more private capital. More private capital demands higher yields. Those higher Treasury yields become the benchmark against which the rest of the economy prices risk. In effect, monetary restraint is pushing in one direction, while fiscal expansion pushes in the other. That's the first collision. Now comes obstacle number 2, the bond market itself. Kevin Warsh controls the effective federal funds rate. Today, that overnight policy rate sits around 3.63%. That is the price of overnight central bank money. But it isn't the price that finances America. The market decides that. And right now, the market is voting differently. The 2-year Treasury trades between 4.16 and 4.21%. The 10-year Treasury trades between 4.55 and 4.60%. Those numbers matter because mortgages aren't priced from the effective federal funds rate. They're priced from the 10-year Treasury. Corporate borrowing isn't priced from the overnight rate. It's priced from Treasury benchmarks and corporate credit spreads. Commercial lending, infrastructure finance, project investment, they all look to the broader discount rate structure, not simply to where the Federal Reserve parks overnight cash. That's the distinction most people miss. The Federal Reserve establishes the overnight anchor. The bond market determines the broader cost of capital. And when market yields remain materially above the overnight policy rate, the market begins tightening financial conditions on its own. Borrowing costs rise, investment hurdle rates rise, discount rates rise. The market starts doing part of the Federal Reserve's job for it, without a single additional rate hike. Now, the third obstacle: inflation itself. For a brief period, it looked as though the battle had been won. Headline inflation had fallen toward 2.6% during 2025. But the victory didn't last. Inflation reaccelerated. Headline consumer price inflation climbed back to approximately 3.5%. Energy prices became volatile. Petrol prices surged. Geopolitical tensions across the Middle East added fresh uncertainty to global energy markets. Meanwhile, core consumer price inflation, excluding food and energy, hovered around 2.6%. Economists spend a great deal of time discussing core CPI. But households don't buy core CPI. They buy petrol, electricity, groceries, heating, transport. Real life runs on headline CPI, and that's what shapes public expectations. If households begin expecting 3.5% inflation, workers demand higher wages. Businesses lift prices to protect margins. Consumers accelerate purchases before tomorrow becomes more expensive than today. Expectations begin feeding the inflation they fear. That's when inflation becomes self-reinforcing. And that's exactly what every central banker wants to avoid. Because once inflation expectations become unanchored, Winning the battle becomes dramatically more expensive. 3 obstacles down, 2 still standing, and from here, the choices only become more difficult. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. 3 obstacles down, 2 still standing, and this is where the mission becomes genuinely dangerous. Obstacle number 4. The collision between inflation and the greatest capital investment boom of the modern era. At first glance, the solution seems obvious. Inflation is running at 3.5%. The Federal Reserve's target is 2.0%. So why not simply pull the interest rate lever one more time? Why not raise rates aggressively? Stamp out inflation and finish the job? Because every action has a cost. And today's economy carries more interest rate sensitivity than most people realize. Across the United States, hundreds of billions of dollars are flowing into artificial intelligence, data centers, high voltage transmission, power generation, semiconductor fabrication plants, networking infrastructure, cooling systems. Entire industrial ecosystems are being built from the ground up. None of this comes cheap. Every one of those projects requires enormous quantities of debt, equity, or both. Raise the cost of capital too aggressively, and the economics begin changing overnight. Project hurdle rates move higher. Corporate valuations compress. Private credit markets become more selective. Financing windows begin closing. Investment slows. Not because the technology stopped working, but because the money became too expensive. That's the paradox. The Federal Reserve wants to slow demand, but it doesn't want to suffocate the very productivity revolution that could expand future supply. Push too hard, and you risk choking off one of the most important technological build-outs in generations. Which brings us to the 5th obstacle. The Japanese yen carry trade. This is where domestic monetary policy collides with global finance. For years, global investors have borrowed money in Japanese yen. Why? Because Japanese interest rates remained exceptionally low. That borrowed yen was then converted into US dollars and invested into higher-yielding American assets. United States treasuries, corporate bonds, credit markets, a classic carry trade, borrow cheaply, invest where yields are higher, collect the spread. It works, until it doesn't. Suppose Kevin Warsh decides inflation is becoming too dangerous. Suppose he responds with another aggressive rate hike. The yield gap between the United States and Japan widens even further. Currency markets begin moving. Volatility increases. Leverage starts becoming uncomfortable. Margin calls appear. Investors are forced to unwind positions. Treasuries are sold. Corporate assets are sold. Equities are sold. Capital begins moving in reverse. What began as a domestic inflation decision suddenly becomes a global liquidity event. That's the reality of modern financial markets. The Federal Reserve doesn't operate inside a closed economy. It operates inside a global balance sheet. And every major policy decision echoes far beyond American borders. Section 4. Now, step back. Look at the entire battlefield. Kevin Warsh stands in the middle carrying only 2 tools, the interest rate lever and the balance sheet button. Everything else is constraint. If he cuts interest rates to support equity markets, protect artificial intelligence investment, and relieve pressure on private credit, the bond market may decide inflation is no longer under control. Investors demand higher compensation. Treasury yields rise. The 10-year Treasury pushes through 5%. Financial conditions tighten anyway. If he raises rates aggressively to force inflation back toward the Federal Reserve's 2.0% target, he risks breaking private credit, crushing highly leveraged sectors, and triggering disorderly adjustments across globally leveraged capital markets. And if he simply holds the effective federal funds rate steady, around 3.63%, while inflation remains around 3.5%, the bond market may simply bypass him altogether. The 2-year Treasury remains above 4%. The 10-year Treasury remains around 4.6%. The broader market continues enforcing its own higher price of money. That's the structural conflict. The Federal Reserve establishes the overnight policy anchor, but the market determines the broader cost of capital. And when those two begin pulling in different directions, monetary policy becomes fragmented, government borrowing continues, Private credit continues. Strategic investment continues. But the adjustment isn't shared equally. Households feel it. Small businesses feel it. Interest-sensitive sectors feel it. The economy doesn't tighten evenly. It tightens unevenly, fragment by fragment, sector by sector, balance sheet by balance sheet. That's the drive. That's the conflict. And that's why Kevin Warsh remains caught between a rock and a hard place. Because until monetary policy, fiscal policy, and the bond market begin pulling in the same direction, the Federal Reserve will continue steering the overnight rate while the market increasingly steers the broader cost of capital. That's the signal. Everything else is noise. I'm Flint West, and this has been your Macro Vibe Check. Flint West, signing off.